This is Hajirunnisa from Associate Professor of Commerce and Management Department would like to deliver a lecture on IFRS Part 3 List of Accounting Standards. So far, International Accounting Standard Board has issued 16 reporting principles, that is financial reporting standards. IFRS 1 relates to first time adoption of international financial reporting standards. It sets out the rules and procedures that an entity must follow when it reports in accordance with IFRS for the first time. IFRS 2 deals with share-based payments. There are three types of share-based payments, that is equity share-based payments, cash share-based payments, and goods share-based payments. IFRS 3 deals with business combination. It provides rules for recognition and measurement of business combinations and prescribes to apply the acquisition method in accounting for it. The next is IFRS 4. IFRS 4 deals with insurance contracts with financial reporting for insurance contract. IFRS 5, it deals with non-current assets held for sale and discontinued operations. And IFRS 6, it relates to exploration for and evaluation of mineral resources such as oil and natural gas resources and other non-regenerative resources. IFRS 7, this accounting standard deals with financial instrument disclosures. That is, it prescribes what disclosures an entity shall provide about financial instruments in its financial statements. That is for financial position and performance, and it also deals with three types of risk, that is liquidity risk, credit risk, and market risk. IFRS 8 relates to operating segments, that is the products and services geographical area in which it operates. IFRS 10 relates to consolidated financial statements, the procedure of consolidation and reporting. IFRS 11, it relates to joint arrangements, joint operations recognized and reported. This standard classifies joint arrangement into two categories, that is joint operations and joint venture, how they are reported in financial statements of parties to joint arrangements. IFRS 12, disclosure of interest in other entities, that is subsidiaries and joint arrangements. IFRS 13, it relates to fair value measurement of assets and liabilities in quantitative form. IFRS 14 refers to regulatory deferral accounts, and it refers to specify the financial reporting requirements for regulatory deferral account balances that arise when an entity provides goods and services to customers at a price or rate that is subject to regulation. And IFRS 15 relates to revenue from contracts with customers, such as cash flows arising from a contract with customers. And the last accounting standard is IFRS 16. This accounting standard deals with leases, that is operating leases for both lessees and lessors. So these are the 16 accounting standards which are issued by International Accounting Standard Board, relates to a specific transaction and The next topic of discussion is conversions of IFRS in India. The need for conversion with IFRS is due to globalization of business world and the regulations which support it, as well as the development of e-commerce, make it imperative to have a single global accepted financial reporting system. A number of multinational companies are established their business in various countries with emerging economies and vice versa. The entities in emerging economies are increasingly accessing the global markets to fulfill their capital needs, and emerging economies are increasingly accessing the global market, and by getting their securities listed on the stock exchange outside their country, capital markets are thus becoming integrated, consistent with this worldwide trend. More and more Indian companies are also being listed on overseas stock exchange. Sound financial reporting structure is imperative for economic well-being and effective functioning of capital markets. The use of different accounting frameworks in different countries, which require inconsistent treatment and presentation of the same underlying economic transaction, creates confusion for users of financial statements. This confusion leads to inefficiency in capital markets across the world. Therefore, increasing complexity of business transactions and globalization of capital markets call for a single set of high quality accounting standards. High standards of financial reporting strengthen the trust investors place in financial and non-financial information. Thus, it has become the need of an hour to have a single set of globally accepted accounting standards has prompted many countries to pursue convergence of national accounting standards with IFRS.